welcome to Recording in the Journal and Posting to the Ledger. Let's get started. Let's first review our acronym from the last module, DEALER, D-E-A-L-E-R. The accounts that increase with debits are dividends, expenses, and assets. Accounts that increase with credits are liabilities, equity, and revenue. In order to move forward, we have to commit this to memory. When we want to increase an asset, an expense, or dividend account, we should debit that account. If we would like to increase a liability, equity, or revenue account, we must credit that account. Let's take a look at some examples. On our screen, we have a subset of a journal. We have the account name, the amount debited, and the amount credited. We'll use that to record our transactions. First, we borrow $10,000 from the bank. Analyzing this transaction, we know that cash is received, cash is an asset, so we have an asset cash increasing. The way we record that in the journal is by debiting cash $10,000. Since cash is an asset and assets increase with debits, we're debiting cash. We have an obligation to repay. Therefore, we have a liability increasing. When we have a liability increasing, we're going to credit the liability, in this case, notes payable for $10,000, the amount that we're obligated to repay. The transaction is we borrow $10,000 from the bank. It's recorded by increasing cash, by debiting cash $10,000 and crediting notes payable $10,000. Our next economic event is to sell $20,000 in common stock. Here we're receiving cash, an asset. An asset cash is increasing. So we'll debit cash $20,000. Assets increase with debits. We're also increasing the claim on the owner's business. The owner's claim is equity, so we increase the equity account common stock. Equities increase with credits, so common stock is credited by $20,000. Our next transaction is to pay $5,000 in cash for equipment. Equipment is received. Equipment is an asset, so we have an asset going up. We debit the asset account equipment for $5,000. We also have cash being paid. Cash is an asset. Since cash is going out, our asset cash is going down. So to decrease our asset cash, we credit cash $5,000. The economic event is to pay $5,000 cash for equipment. The journal entry to record that is to debit equipment $5,000 and credit cash $5,000. Our next transaction is on December 31st, Great Pizza Company received $3,000 for pizza delivered to customers. Here, we're delivering pizza, so we have a revenue account increasing. To increase revenue, we would credit the sales revenue account. Anytime that we credit sales revenue account or any revenue account, net income increases and equity increases. We're receiving cash. Cash is an asset, so we have an asset cash increasing. To increase an asset account, we will debit that asset account for $3,000. The economic event is we received $3,000 for pizza delivered to customers. Cash coming in increases our cash balance, so we debit cash $3,000. We provided delivery pizza to our customer, so since we provided pizza to our customer, we earn that revenue, so we increase revenue by crediting revenue $3,000. Our next transaction is paying $2,500 for expenses. We're told that we have expenses. That means expense goes up. We used a good or service in the production of the pizzas. In order to increase an expense, expenses increase with debits, so we debit our expense account $2,500. An increase in expense account decreases net income and decreases equity. We're paying cash, so our asset cash is decreasing. To decrease an asset account, we would credit that asset account for $2,500. Next, let's look at the ledger. We have our first journal entry recorded, a debit to cash and a credit to notes payable. To post this to the ledger, we would increase our cash account by debiting cash $10,000 and increase our notes payable account by $10,000 by crediting notes payable. Remember that the journal and the ledger are both necessary in an accounting system. The journal represents a chronological listing of all the transactions, whereas the ledger summarizes the transactions affecting a particular account. Next, we receive cash of $20,000 in exchange for common stock of $20,000. We already have our cash and notes payable ledger accounts established. We need to add our common stock. We're going to increase our cash account $20,000 and increase our common stock account $20,000. Our next transaction is to record equipment for $5,000. We're paying cash for that equipment. We already have our cash, our notes payable, and our common stock account, so we need to add our equipment account. We have a debit to equipment, so the equipment ledger account will be debited for $5,000, and the cash ledger account will be credited for $5,000. If we want to calculate balances, we draw a line and record the balance for each account. In the case of cash, we have a $10,000 and a $20,000 debit and a $5,000 credit. 10 plus 20 minus 5 gets us to a $25,000 balance. The ledger, after all entries are posted, are as follows. The cash account has a balance of $25,500, notes payable $10,000, revenues $3,000, equipment $5,000, common stock credit balance of $20, and expenses debit balance of $2,500. Keep in mind that we didn't illustrate all of these transactions in the module when we were looking at journalizing and posting, but after all the transactions are posted to the ledger, we have this information. So now let's review. Accounts that increase with debits are dividends, expenses, and assets. Accounts that increase with credits are liabilities, equity, and revenue. I know we've said that a lot, but I can't emphasize the importance enough. You must commit this to memory to be successful.